Implementing risk-based position sizing into a trading strategy by carefully combining with an intelligent stop loss can help produce significant improvements in the equity curve. Stay tuned. Darwinex is a UK FCA-regulated broker and asset manager on a mission to disrupt the financial trading, investing and asset management industries. If you're a talented trader looking to attract investor capital to your strategies, Darwinex is the fastest way for you to do this. We enable traders to raise third-party investor capital and then charge success fees on high watermark profits. Additionally, Darwinex itself invests in its traders with our seed capital allocation program that allocates up to 90 million euros per year in successful trading strategies. So, if all of that sounds interesting, learn more by clicking on the link here, or you can find further links in the description right below. Now back to today's tutorial. Using risk-based position sizing can standardize the risk of each trade, which firstly helps to remove biases from the backtesting process, but secondly helps to smooth out live trading strategy growth. In today's episode, I implement this type of position sizing for the Ichimoku strategy that we've been studying. Let's take a look at the results of this. As always, all previous episodes from the Spotlight on Indicators series can be accessed from a link in the video description. Now, last time we started from this baseline, which was the implementation of the basic strategy, and by adding a stop loss, we were able to improve the performance both visually and also quantitatively, as shown here. So let's now take a look at how we're going to change the implementation using that stop loss in order to achieve a standardized trade risk. So we have a crossover, and in this case it's a bullish crossover, which means the Tenkan Sen is crossing above the Kijun Sen. And when we have a bullish crossover like this, we implemented a stop loss on the opposite side of the Kumo, or the Ichimoku cloud. And for bearish crossovers, it was the opposite way around, so the stop loss would be set at the top of the Kumo. But now we're going to start thinking about that worst case risk for a trade. And for this, we're not interested in the level of the crossover itself. Instead, we're interested in where the price action currently is at the time of the crossover. So in this case, that's just slightly higher than the crossover here. So the distance that we're interested in terms of calculating the risk is between this level and the stop loss. And what we need to do is select a position size for the trade that ensures a move in the price of this distance results in the same percentage loss for each and every trade. So if the distance is large, then we would want a smaller position size relative to those instances where the distance is small, where they could have a higher position size, but all would result in the same percentage loss on the account. So as an example, we could set this so that each trade had a maximum risk of 1% of the account value. Or if you're more risk averse, you could choose 0.5% or even 0.25%. So initially I'm going to use a 1% risk, so let's take a look at what that produces in terms of the returns. And again, we'll come back to this a little bit later when the backtest has finished. Okay, so that's now finished, and we can see visually this has a different equity curve than when we were using minimum lots. And that's because we've now standardized that set amount of risk for every trade. Whereas before, when you're using a fixed position size, each trade would have had a different level of risk depending on how far the stop loss was from the entry. And if we now take the two equity curves that we had previously, So the green one here, as a reminder, is the basic implementation without a stop loss, and the orange curve is with a stop loss. If we now plot these new results onto this same chart, what you see is that the green and orange curves now look almost flat, because the returns achieved there are so small compared to when using the 1% of risk per trade. So what I've also done is run this test with a much smaller level of risk, 0.25% per trade. And if we take a look at how that compares to the green baseline and the orange line, that allows for an easier comparison. Now, it is quite interesting to look at the two equity curves, which is the one using 0.25% risk and the other using 1% risk, side by side, and this is what it looks like. And here with 1% we start to see exponential growth. So whereas with 0.25% this relates more to a linear increase in the equity, whereas we can definitely see the exponential nature start to come into play with those higher position sizes. And of course, exponential growth is what we want to start achieving with our position sizing if possible. However, the downside is with this strategy in its current form, the drawdowns are simply too large using 1% risk. So if we take a look at this drawdown at the beginning of the test, this represents a 60% drawdown on the equity value. If we take a look at this one here, again, this is somewhere in the region of 55 to 60% drawdown. This one here is approximately 25%. So these are certainly drawdowns that would be far too large for me to tolerate personally. And so in its current form, I'd be wanting to risk much less than 1%. But of course, if the quality of the strategy can be improved by optimization, by enhancing the stop loss strategy, so for example, implementing a trailing stop loss, and so on, then it may well be possible to produce an equity curve that has much lower drawdowns. And if you can achieve that, then you can start to carefully and slowly increase the position sizing aggressiveness. But only if your live results concur with your backtest results. So moving on to the next episode, I'll be introducing a trend filter into the crossover strategy to see if we can improve the quality. And then in episode 17 that follows this, look at an alternative trend filter using the Chiku span. And many strategies that I've seen use these in a combined way together, but I'll be taking a look at them individually to see what effect they have and also using them then as a combined filter. That's it for this episode, but wait, before you go, do you want to find out more about Darwinex? To find out how we help thousands of traders attract investor capital, either click on the Darwinex logo on the screen or find other links in the video description. Now, until next time, trade safe.